All right, ladies and gentlemen, we're back now onto the fourth episode of the John Gill Podcast Show. And yeah, super excited. I have here today the man, the myth, the legend, my best friend, business partner, Anand Trivedi, managing partner and founder of AUM Capital. And thank God, first off, Anand, I just want to say thank you so much for coming on the show today.
Hey, of course, man. Come on. I have to tell you, this is my first podcast, and I had to look up what an actual podcast was on my way here. I'm being totally honest.
I know.
So
I
I think
hear
this is awesome, and
Cool.
I don't know if I'm saying hello to the world, to the
Yeah, you're
public,
saying-
to the real estate community, but hello,
Everyone.
all right, everybody. I'm Anand.
And thank you so much for coming on the show. Tomorrow he's going out of town. So of course, the one day that I decide, hey Anand, can you come on? It's T minus what, a few hours before you're
all
you're
good.
out of the States. So-
Anything to support the cause, man. Anything to
Awesome.
support the cause.
Awesome. Well, dude, I just want to say first off, again, thank you. And Anand, why don't you go ahead and just share with the audience a little bit about yourself, what it is that you do, and just to get people familiar with who you are.
Sure. So Anand Trivedi, I grew up in the suburbs of Chicago. I am, I'd like to say, a handsome college graduate of the University of Illinois, Chicago.
There he is.
And studied economics. Did a few things, dabbled in a few different types of businesses, but I think right out of college, went straight into the world of real estate. At that time, a very distressed time in 2008.
It was a crazy time. Do you remember we were in the UIC? I said this on my first podcast, by the way. Anand, we both were in the real estate finance class with Tom Bothan.
Tom Bothan. Shout out to Tom Bothan if he's
Shout
listening.
out.
The reason that I think we both chose real
Yeah.
estate was probably 60% of your class.
Absolutely.
Not to say that we got 60% in the class, but
Well, you got 100. I was kind of more probably there.
I don't know.
I
Don't
passed,
audit my grades.
Well, I mean, you were smart enough that I had to sit behind you in class and kind of look over. And this is the guy that I said on the first podcast. He kind of covered his answers a little bit. I give you
It
shit
wasn't
for that.
I was just so large that the seats in front were big enough for me. So
Exactly.
Yeah.
But at the time you were at AUM Capital. I'm sorry, at Mana Capital.
Mana
sorry.
Capital, yeah. So 2008, I joined a real estate investment fund, and at that time we were looking at I think kind of a multi-class of properties. We were doing we're looking at multifamily, looking at office, income producing stuff that made sense. When I started in May of 2008, and I think shortly after, I would say probably closer to September when we went back to school, we had news that Lehman Brothers, AIG, all these
I remember that.
banks were
Jeez.
kind of collapsing. So at that time it was very interesting because we put really all acquisitions, all investments on hold, and really didn't know what to expect. So we spent the next, I think, year kind of on and off over there. I interned in 2008, and then spent the next year, 2 years, I believe, going kind of in and out of the office, looking at different deals. At that time, banks were taking back a lot of properties, a lot of distressed stuff. I mean, there was debt that we could have purchased for 20 cents on the dollar. There was properties that we could purchase for just super cheap. And I think what kind of through that whole thing is what the understanding and I think learning process of actual real estate for me specifically kind of came about. So kind of going through that process, seeing what properties had traded for between 2009, 10, 11, where we really kind of were growing, kind of set the foundation for kind of our understanding of real estate
Sure.
and investment real
Absolutely.
estate specifically. So yeah, so I think it was a great experience. I think it was a great time. Uh, you know, I would say that from that point onwards, we were buying at that time 2 units, 3 units, single family homes. Some of it we rented out, some of it we kept, some of it we flipped,
Hmm.
and kind of just gradually increased. So we started the single family homes, 2 units, 4 units, 6 units. Then we went up to 10. Then we went to 20, 30 units per asset, and then we bought and just a range. And then I remember the day that we bought our first 50-unit building,
Hmm.
and that was a whatever 60,000 square foot some building, had 13,000 square feet of commercial space, 52 apartments above. And at that time in Chicago was you were buying things for, I mean, I don't know, we bought that building for I think $2.5 million.
Hmm.
Can't find those deals anymore.
Can't
So
find that. Yeah. And that was, I remember. I think that was
that
that
was
was in Andersonville, right?
Edgewater, but the
In Edgewater.
it kind of was the catalyst to see how you can grow from doing two units, 3 units, single family homes, and kind of
Hmm.
increasing, and efficiencies, operations, maximizing management, maximizing construction, and moving to bigger projects. And from a 50-unit building, then we invested in 100-unit buildings, 150-unit buildings, and now obviously I'm no longer there, but now they're doing units that are no less than 250 units, and um, it was great to see that operation, that scale. At that time we touched, I specifically touched everything from, leasing, management, operations. I think, I dabbled in construction. We oversaw a crew of guys, different projects. Looked at the financing, prepared financing packages, acquisitions, moved into acquisitions, and so really, I was very blessed to have the experience to kind of touch each department in a real estate fund or management, and I mean, however you want to look at it. But
Hmm.
um,
And that's amazing. The fact that you were able to get that hands-on experience. It's not you weren't just in one department. I mean, I think that also carried on to a lot of the experience that you were then able to go on your other future endeavors. Let's talk about though that one of the big projects that you did on McHenry. I think that's a very interesting project. If you can just share with us a little bit about that.
sure, I'm a numbers guy, so I have to. I only remember projects by numbers.
Sure, sure.
Uh, McHenry, Illinois was a deal that we had 27 new construction, or that time new construction units, condo quality units. That was above approximately, I think, about 15 to 20,000 square feet of retail, right on the river in downtown McHenry. Um, the developer that we had, well, we purchased it from the bank, but the developer who had actually developed the building, just you over leveraged and wasn't the right fit for that project. It was a bad time,
Hmm.
kind of lost the deal. We picked it up from the bank. McHenry was very interesting. There was TIF, which for the community that doesn't know, tax increment financing. So the deal was a little interesting in terms of how we acquired it, and then also what the I would say the city or the village actually committed to the project as well through public taxpayers and
Okay.
things of that sort. So it was a very interesting process. Yeah, the first project that I ever did with boat slips that were available. I don't know if you guys have ever
Nice.
bought or rented out boat slips, but that was pretty cool.
Nice.
Big boating community out there. Shout out to my McHenry people.
There they are.
Uh, so yeah, so I mean, McHenry was a great project. We leased that up. So
That was also adaptive reuse, wasn't it?
so that was existing construction.
Okay.
But what we did was we came in, we finished the building. Basically, the public was viewing the project as, they were saying a lot of nasty things about it. They didn't want any type of subsidized housing there. They didn't, they wanted to make sure that the downtown area remained vibrant, urban,
Hmm.
conducive to kind of what their
Hmm.
original plan was. So, we had a couple of hoops and jumps to get through, and I saw it kind of in behind the scenes. But when I got there, we did construction for, I would say, about a good I'd say a good maybe 6 months. And we leased up the building to 85% in 6 months. And then for the residential portion, and then we got to 90, 95,
Nice.
and then we started leasing up the retail. So it was a very cool. Yeah, I know construction does that too. Um, it was a very cool process to go through, and we saw a lot of we and like I said, I touched a lot of different aspects of that deal and learned a lot. Um, so yeah,
That was it. Yeah, that's amazing. And then at what I think we were both at the time still at UIC. You were at Mana. I was learning. I remember I was actually pitching you guys a few deals when I on the brokering side as well. And you and I had said, it'd be great one day if we could partner up and maybe or down the road that we would be able to kind of do some projects together.
Absolutely, absolutely. I mean, we were
Remember
kids.
that? Yeah,
We were
yeah,
kids driving through the city, looking at buildings. We were like a kid in a candy
yeah,
store at that time. Just,
yeah.
I think what was great about it was, I remember that the process in order to do your first deal that you own, right, is, and I joke around now to a lot of people about how that, but we saw probably what, maybe every week we were looking at least 20, 30 different types of deals.
Sure.
Stuff that was listed, stuff that people would call about. I mean, I think there was so much. I remember, John, at one point,
Hmm.
and I'm gonna say it, I guess this is the first time
Yeah,
I can actually publicly say
sure.
it, but yeah, I mean, we were breaking into properties.
Yeah,
You know what I mean? Like
yeah. No,
I mean,
what
it was.
happened was the lock boxes. There'd be assholes that would take the
I hope
keys out of
Chicago
the lock.
PD's not listening, by the way.
Yeah, no, well, what happened is they would steal the lock boxes, right, and put the offers in so that no one else can
Y-
submit.
yeah,
What are you gonna do? Okay, there's a window, you
don't trust
know.
every broker out there.
Yeah, that's another thing. Yeah,
There's a well, no, I mean,
it's
listen, I mean, the people
true.
wanted to give their own family, friends deals. I mean, I think for us, we looked at that, and there would be board ups, right? And
Hmm.
we would have to get in because why were we making offers unless we actually knew what was inside?
Sure.
Do we have to tear down everything inside the building? Can we use some stuff? Can we keep existing? Were there appliances? Do we have to? I mean, everything was down to the dollars and cents.
Hmm.
And I remember the day we got our first deal, and it was like, oh my god. And kind of went through the construction and all that process, and then we turned it around, and I think
Hmm.
sold out of that project, did very well, and I think kind of was the catalyst
Yeah.
to what would set us up for, I think, a great venture, and to do a lot more stuff. And yeah.
Well, let's talk about that. AUM Capital, you and I are both partners. And, AUM Capital, Anand, do you want to just talk about the company and some of the where we're at today and kind of where that, when you left Mana
Hmm.
and went off to do I'm sorry, AUM Capital,
Hmm.
how was that transition like for you? And then, what,
Tough. I think it was
yeah.
very scary. I think it was. I think, to be honest, the market. We were there until 16, and I have high respect for the principals and everybody in the company there, and I think really it was a point where you decide as a person that says, I think if you've invested in a class, or I guess real estate in this case, right? If you've invested in
Hmm.
real estate, you kind of know what it takes, and you also see a lot of the downfalls and a lot of things that slip through the cracks, and you see a lot of you know things that kind of in a company that you have to look out for, and one person can't do everything. So, you know,
Yeah, that's the one thing that you've said consistently. You can't, because as real
yeah, I mean,
estate and a lot of us want to just do everything from A to Z, contractor acquisitions, management. You know,
yeah, I mean, listen, it's a
definitely
very
delegation is a very important key.
yeah,
Yeah.
it's very difficult. And I think also too is that everybody's got in the company strengths and weaknesses, and we looked at it, and I made a personal decision, and I said, you know what, we're at a point where I think there's going to be still some time to grow, to buy assets. Let's focus on it, and I definitely took a hit for a while in terms of it was nice to get a check, and I mean a lot of people out there that work for companies, it's absolutely nice to get a check every single 2 weeks or whatever, a
Absolutely.
week or whatever, however the structure is. And I think looking back at it, I think I think it was a great decision. I think the learning aspect of it is still told even told to today is, we have a very, very um hands-on approach to everything. AUM Capital, it's I mean, we are a real estate investment company. I would say boutique. I still don't know what boutique means, but
But
uh,
it sounds
we're a
nice.
boutique real estate investment company, and we like to buy projects that we can add value to in areas that we believe are um, maybe not there today, but I would say are kind of on the cusp of coming out. So I mean, in Chicago, if you look specifically, we're bullish, and we generally like the areas in Logan Square, Bridgeport, Bronzeville, Pilsen,
Humble
um,
Park.
Humboldt Park. I think really, I mean, we really will look anywhere, but I think if we look at a map of Chicago and we draw three circles around, the first circle would be around the downtown area that we'd call maybe tier one. That's your River North, your Lincoln Parks. I would say your old towns, all your really established nice neighborhoods, Lakeview,
Hmm.
and then you draw a second tier, and those second tier neighborhoods include kind of your Humboldt Parks, your Pilsons, your Bronzeville, your Bridgeports, kind of the outliers, the near west side. And then your third tiers are probably areas of Chicago that, are either a little further west, a little further south. So I like to always describe it that we like to stay in that tier two. And I think we found a lot of value in the tier two. Um, People that can't afford, I mean, we're in the rental business, right? So I think we look at the tier one, renters as we can't compete with those.
Hmm.
We're never going to be able to be your River Norths or your downtown Chicago. You can't build high rises in these tier two markets. There's different restrictions and zoning and density
Hmm.
questions. So the tier two markets, we think that we can still, add value to. There's a lot of older products still available, so we like to renovate and try to bring as close to possible and to newer finishes without spending, and new construction prices. I think we've seen a lot of challenges in that aspect of construction and what we can actually do and put in there.
Yeah.
So yeah, so I mean, we're very simple. I mean, we'd like to do bigger deals. I think a lot of these, um, I think a lot of deals. I think timing is really key in real estate, but I also think that a lot of the product that we would like to go after is harder and harder to get, and kind of pushes us out. So I mean, we're really bullish on readaptive reuse. I know we were discussing that. The suburbs of Chicago. There's some really really nice pockets and suburbs that need I would say quote unquote affordable housing where we're not luxury rental, unless the market unless we see it, but we get really really nice units that are
Hmm.
above you know standard finishes, and we create a nice clean
Right. Some
simple
granite. I mean, we're
product.
just talking some granite,
Yeah, I mean,
some
kitchens,
yeah,
kitchens, we still got
yeah.
the 42-inch cabinets. We still
Right.
do, hardwood floors. Sometimes we'll do, Uh, you know, I really think it's just what we're working with on each project. So
Yeah, no, absolutely. And then, so some of the challenges that I think we've seen recently has been going back to what you said earlier, you know, the acquisition of properties, finding properties back in 2009, 2010. I think we kind of, a lot of people now, kind of took it for granted, the amount of inventory out there. How have you been able to adjust to the current market, and what sort of deals are you looking at today that you might have not looked at, um, you know, years ago? Meaning on
uh,
the pricing, like, I
I
mean, obviously the pricing structures
yeah,
have
I
had
think
to change,
yeah,
adapt.
I think listen, I think prices have increased. I do want to say this because I think it's important for anybody that's getting into real estate investment, specifically maybe multifamily. Um, and you can maybe even apply this to a lot of businesses, either franchises you want to go after or even the stock market. But you have to have principles. And
Mhm.
I think, we were really, um, I really, follow, a gentleman named Ray Dalio's advice and how he kind of structures his company. He's one of the most successful hedge fund managers in the world. And people ask him all the time, what makes it successful? I look at it, real estate, probably the same way that I saw it 10 years ago. And your fundamentals of investments and properties,
Mm.
you you need to have a base foundation for, and you have to stick to those principles. Now, are there going to be decisions that are going to, or are there going to be, factors that maybe you can change your decisions? For example, listen, it's on a nicer block, and oh, maybe I have maybe I have a tax obligation, and I need to, sure, that's situational, and that you're going to rise. It's going to rise no matter what. But the principles of real estate investing should stick to your current model. Okay, what we're seeing in this market is a lot. And I'm telling you, we deal with it on a daily basis. A lot of investors making absolutely stupid mistakes. And
Yeah.
it makes me
Yeah.
it makes not only terrified, but it also makes me upset because they lack any type of structure or principles. They say, listen, we don't mind paying whatever for this property. Yeah, it's gonna appreciate. They take no account into operating expenses. They take no account into taxes. They take into account, oh, the money's cheap right now. Interest rates are low. Well, we'll be fine. It's a bad way of looking at it because it can maybe work in the short term, in my opinion, uh, and they could do very well in the short term. But long term is it's a bad model. It sets them up for failure, or they have to sell, or they'll probably sell for what they're in it for. So I would say, you know, principles are very, very important. I think we look for, anything we can add value to. From the investment world, we look at cap rates and amongst other things, but you're going in cap rate. It's essentially, it doesn't matter what you're buying it for in terms of what it's making today. It's about what you can get to tomorrow and if you can add any value there. Because I can buy a building at a six cap and my expenses could go up because it's either an older product or if it's mechanicals need to be changed out, the roof needs to be replaced in the next 5 years, your boilers go out, your taxes increase. Tax increase is huge in the city of Chicago. And I hope if the treasurer is listening to this, and I'm really hoping that
Yeah.
Mr. Fritz is going to chime into this podcast, but it is absolutely
We'll send them the
ridiculous.
link. Yeah.
Yeah, it's ridiculous what's
Yeah.
going on in Chicago and I think Cook County in
It is.
general. And I think there needs to be a fair way to assess taxes. And I think there's a lot of us as building owners will probably agree is that we can't support, you know, we can't support,
Well, that's the thing.
huge
What?
tax
Yeah.
increase.
I mean, it's almost
Rents
as,
are going down. Rents are
Mhm.
not going up. So we're already taking discounts. We're already taking haircuts. Incentives are coming back. Concessions are coming back after a 4 or 5 year break, and we're having to give months of free rent away to entice renters to come back. So I really don't I really think that a lot of investors need to look at this. I think also anybody that's getting into it, please budget accordingly. Construction prices have gone up, taxes are going up. It's kind of like, okay, well, but should you still discount a property for those items, right? So if I walk into a building and say, oh, this is a beautiful building, but I may have to replace the tanks or the water tanks, or I got to replace the hot water, or sorry, the furnace, or oh my God, the roof is almost about to. That could be adding an extra $100,000 to your budget. So I just, it's very frustrating to see that. So a lot of investors are paying up for it because maybe they have the money, they have access to the money. A lot of these guys are fund managers,
That just have to do deals. I mean,
they have to do deals.
yeah.
And that's probably maybe another podcast you probably invite me back out for. But,
Absolutely.
I will absolutely share my
Disgust.
my disgust and frustration with all you money managers out there that
Yeah.
are feeing up investors without without having whatever. I'll just
No,
I don't know
like
if there,
that.
I don't know
that
if there's
energy.
I don't know if there's a bleep on the
No.
on the computer over there.
Say
But you can
it,
just
say it.
bleep bleep bleep
Go for
bleep.
it. Yeah.
But
No, we talk about that a
But
lot.
it's fucking crazy.
Yeah, we
It's
talk about
absolutely
it all
crazy.
the time. I mean, and you talk about it more so than a lot of people. I mean, it's like,
It's absolutely
it's
fucking
yeah,
crazy.
it is.
And I'm going to tell you this: fund managers that have to put capital, so that they have to put money out on the street in real estate and all that stuff because they're going to lose either their investment partners or they're going to lose the commitments that they have. You cannot change the economics of a deal just because you want to get paid. It's fucking bullshit.
Yeah.
You guys deserve to fucking, like not be in this business because you what you guys are essentially doing is saying, I don't really care if it makes money. I don't even care if it really cash flows. Okay, maybe it'll cash flow, but guess what? I'm still going to get my percentage at the end of the day. That's a very, very poor way to look at real estate. It really fucks all of us.
Yeah.
Because our property values. Oh, guess what traded next door? Yeah, well, what you guys don't know is that that person next door could be a fund manager. It had to do it. So you know what? Instead of paying, if you $700,000 for a house, yeah, all right, maybe he had to pay $800,000. But you know what? Guess what? He got his cut at the end of the day. Is the house really worth $800,000? I don't think so. So, anyways, I know it's.
No, I love it. I
I don't
love
know
it.
if
That's
we're really going that
exactly.
direction, but
Yeah, yeah, that's
it's
exactly what
disgusting.
we're
It's
doing.
absolutely disgusting.
And no, and I appreciate you mentioning that because some of this pricing has just gotten out of control, and I think it has to be addressed. I mean, it's nuts, and I just see guys just not doing smart deals, just doing deals to do deals, and
I would say in the past, what, John, maybe 3 months,
hmm
I would say we've gotten a decent amount of calls of people that are losing their properties,
Yep.
that are overextended, and have either been, in a situation where they've been what, quote unquote, bad boys, and
hmm
everybody knows what these bad boy clauses are if you're in the financing world, but you guys have been bad boys, and your properties are going to come back for sale. You're going to take a haircut discount or probably lose money on it, but
Yep.
strap in for the ride. I mean, fuck, we'll go after that shit all day, but at the end of the day, what those people are doing is it changes the whole entire fundamental of investing in real estate. So if you guys are, just getting into the game, or you guys are just looking at properties, and get your ass off of Zillow and Redfin, okay, and stop looking at what's traded and using that as your only benchmark for doing deals. Look at what you can actually get out of the property. Show me how much you can actually make comfortably on the property. Okay. Don't look at the banks because your interest rates are 2%. Look at what the property can actually make in the environment that we're in today, and what you can get it to tomorrow.
Yeah. Yeah. Absolutely. That is awesome. Awesome advice. And how do going back to budgeting and some of the mistakes that we've seen with different underwriting models? How some of the things that we've seen now with the trade war going on. I mean, how has that impacted pricing on just things as simple as furnaces, and how does that affect the bottom line?
I would say, uh, I would say, just specifically based on my experience so far, I would say that we haven't seen a substantial increase. However, if you were lucky to lock in pricing, as we have, now and I think previously, is that if you lock in appropriate pricing with vendors, and you have agreements in place, and you have really good relationships, and you're churning out enough product and material, I think that it's not as bad. I would say a lot of the people that are going through this are maybe big developers, people that are doing steel studs, and ordering these huge beams and things for steel prices. I mean,
hmm
I would say it's something that we definitely account for, but I remember my old boss always said, look at your construction budget, and no matter what you put down, even though you think you can get it to that number, add an extra 20% minimum, because it's
Oh
not what you
yeah,
think. It's much more expensive to do it, and the carrying costs, and nobody factors that in anymore. Carrying costs, holding costs, how much time it takes. Time costs you money.
security. I mean the things that no one expect. And if you're in the city, Definitely budget for security.
Yeah. Shout out to the people that steal copper. If you guys are listening to this podcast right now, somehow, shape, or form, I need my copper back for
Yeah. Yeah, no kidding. I mean, unbelievable.
yeah.
$40
But
they're getting, and
entrepreneurs
it's
at
yeah.
heart, I gotta give them some credit, you know? So
Hey,
make a few bucks in copper, shit, why not?
yeah, no, I hear you. They're entrepreneurs, right?
Yeah, spray
Uh,
paint your copper.
yeah, oh, yeah, that's another nice technique, actually. Why don't you explain that a little bit?
I don't know if the city frowns upon it or not. They haven't read the exact codes, but if you are doing projects that require copper in your
Well,
plumbing,
what we've heard that some other developers are
yeah,
doing.
very political. That's very nice.
Yeah.
Very politically correct. I like
Yeah.
that. Yes, what we've heard is that if you do not want your copper stolen, I think it's advisable to spray paint your copper so that basically, if they try to cash it in, it's contaminable.
Something happens where they
Yeah,
can't
it's
get, yeah,
contaminated
or
or
there's a
something, and they can't really cash it in, and they'll get
right.
no money for it. So,
Exactly.
uh,
Exactly.
yeah,
Yeah, definitely. Yeah, I think we found a few guys. Thank God. Another big thing is putting cameras up. We've caught a few people just trying to, you know, jump into the dumpster, see what they find, and then if they catch anything, they kind of
we're
look and see what else is behind the
we
doors,
are.
right?
If you are in the real estate business, and I think a lot of developers, investors, hopefully that are owner operators, as we are, will tell you we are not in the real estate business per se. We are in the firefighting business,
There
and
it is.
every day
Yes.
we are trying to put out, you know, big fires, small fires, and
Yeah.
try to doing it as cost effective as possible. And I think making sure that the fire eventually goes out, but that's where we're at.
Well, yeah, I mean, and that's also part of the underwriting too. I mean, I think a lot of guys they go in thinking, 20, you'll get financials at buildings operating at 25% expense ratio. We look at that and we kind of chuckle because it's almost like, how the hell are you gonna operate really at these numbers? And they don't take into account real maintenance, repairs. I think that's something that definitely has to be looked at as well.
I think every
Realistic underwriting
yeah, and I
expectations.
think listen, every person that in our business has looked at investment real estate is going to argue on expenses. And listen, at the end of the day, you need to make sure that any expenses that you're budgeting for, think about it. Okay, if you walk into an apartment, if you guys are renting right now, think about how much it costs. Call your landlord up and ask him how much does it cost to actually paint an apartment.
Hmm.
How long does it cost? How much does it cost to actually get a crew in there? And you got to paint 1,000 square feet, 1,500 square feet, and then look at your expenses. You can back into your expenses and you can actually see if these are legitimate or not. Take some time, calculate the vacancy, calculate what the T12 was. Look at the rent roll, see how much you're collecting, see how long that tenant's been there. Ask these questions. Don't be afraid to ask these questions because it all goes to your bottom line. And
Hmm.
and especially if you're either raising capital or you're borrowing money to do deals, you need to know these questions. You need to know the answers to these questions because investors, they'll look at it and say, oh, we can get 10%, 12%, 15%, 20%. Yeah, you know what? One wrong mistake on your budgeting, your returns bump down from 20% to 10%. Two wrong mistakes will bump it down from 10% to 5%. you know and anybody that's looking at IRRs and internal rate of returns, and in a 5-year projection, I mean, it affects your bottom line heavily.
Yeah.
So
Well,
yeah.
going back to principles and how you look at a deal, uh, cash flow and equity. What makes a deal sexy to you? There's two different deals. What's the
Both.
one? Okay, that right, exactly.
Look, the way I've always learned and taught, and I think this kind of goes back to the timing that I kind of entered the market, but cash flow can go away very quickly. Cash flow will go away very, very quickly if you have to do, anything to your property. Some people have different models, and like I said, everybody has. I mean, every project's different, right? Every market's different. If we have guaranteed income coming in from a like a CHA or subsidized housing, or I think you can look at that cash flow play and say, okay, well, we're getting guaranteed income, so maybe we should do the deal. Okay, fine. There's that's a way of looking at it. But to look at your cash flow, I mean, there's deals that have cash flowed crazy on the south side of Chicago, on the west sides of Chicago, and investors will get in and they'll think, oh man, I'm going to make 20% cash on cash, 30% cash on cash return. Oh my God, it's
Hmm.
great. You can't even collect it. You're not going to be able to collect it. Your cash flow model is only as good as what you can collect. And if you're not a manager, and if you don't know how to manage property, or you hire a third party management company, you're not going to be able to collect certain amounts of money. And that goes towards your cash on cash. So your 30% then bumps down to 20%. Then your 20% bumps down to 10. And God forbid you got to evict somebody in the city of Chicago or in Cook County, from based on our experience, is you're losing income, a substantial amount of income, and not only to say attorney's fees, and who knows if you can actually go after these tenants that don't pay. So I mean, in our business specifically, cash on cash returns or cash flow can easily be mistaken, and can easily go away. That's why, when I look at a deal, to go back to your question, is that it's gotta work on paper. A, B, it's gotta work both ways. So there has to be a comfortable cash flow play. There has to be a comfortable equity play, and the deal has to be worth going after. Um, you know, Another piece of advice is, never do a deal to just do a deal, right? Because you just want to own real estate. So, you have to make sure that there's upside, to be very successful, or to be even successful in properly. If
Hmm.
it's your money, if it's somebody else's money, you need to be able to have a comfortable equity cushion and a position there, because you know anything can happen, as we've seen. Um, I'm not going to say that we're seeing downturns like the 2000, 10, 11, but I would say that, asset prices are coming down, expenses are going up.
Hmm.
I would say that, rents are coming down, flattening. We're not getting a lot of rent growth
Right.
anywhere really. In fact, we have to even, look at
Mm. Incentives.
you look at incentives. If you have to give a half a month free, you got to give 1 month free. Commissions, you're already losing 2 months, 3 months on rent, and the other 7 months you have to make sure you can collect from this person. So you never know. I mean, we've seen a lot of different things that happen in our business, and that means that if the cash flow play goes away, guess what? You still have equity, and if you need to sell, you can still sell, and you can sell comfortably for a profit. Um, you know, Nobody wants to do a deal to break even. You did all that time, all that money, all the long nights, all of the, tenant
The
calls at 2
headaches.
a.m., all
Yeah.
the headaches. So why not? You should have it both ways. You should try to find those deals accordingly. They're hard to find. They're very difficult to do, but that should be a part of your principle,
Yeah.
and establishing your foundation for doing deals, investing in anything really, right? So
Yeah. No, absolutely. And on the exit, I mean, are you typically seeing, and I think we've kind of gone back and forth a little bit on this when it comes to valuing or coming up with our valuations, price per unit versus cap rate. There's been a lot of times where even on our exits, I remember looking at the at the anticipated list price, and I said, I don't know, if that price per door, it seems a little high relative to the neighborhood, and then you told me, well, no, I mean, look at the cap rate. Look at the returns here. I mean, someone's getting a great deal. And we've kind of gone back and forth on that. And what have you seen? Really, someone should focus on more. Is it on price per unit or cap rate?
two things. I think first thing is that, and I'm speaking specific to our we're in the
Amount, right?
multifamily business, apartments, value add. I would say that it's kind of difficult because we have 3 unit buildings that trade for a higher price per door. I mean, for example, somebody that wants to live in a 3 unit building or 4 unit building. They want to live in 1 unit. They want to rent the other three out, and be able to make that their home, and then have tenants pay their mortgage. Right. Those typically have financing that is 30 years. They have lower interest rates or first time home buyer programs. There's so many different variables, but that person could pay a higher price to live in that 4-unit building because they're making it their home. They
Sure.
they can make the argument to themselves and say, you know what, listen, my mortgage is not gonna I'm gonna have to maybe put a few $100 out of pocket or $1,000 or everybody's gonna be paying my operating expense carrying costs and I'll own a piece of real estate. So I don't know if they're really looking at that same model where we're saying, okay, we're gonna buy something from for $500,000 and we're gonna be able to, add $100,000 in construction and be able to, sell for, $1,000,000. I don't think they're in that model or that same mindset. They would love to be, I'm sure, but I don't think that's the reason for them buying. I think they're more emotionally invested in
Sure.
trying to find a place. So that price per unit could be much higher. Now, if I have a 10-unit building or 15-unit or 20-unit building down the street that maybe we have the same layout. So, that person had a 3-bedroom, 2-bathroom, and I got 3-bedroom, 2-bathroom. He's renting his out for maybe $1,200. I'm renting out mine for $1,500. Well, I'm gonna be valuing my 10-unit building on a different scale. So is my price per unit gonna be less probably from my experience? I would say yes. Um, we recently sold a building in the Bronzeville neighborhood. I think we achieved somewhere around um over about $160,000 a unit. So 3 blocks away, we're looking at a 20-unit building right now, and that 20-unit building is trading for $80,000 a door. So that's almost half of the price as the 4-unit building traded for, already sold. Now, can I jump up and down and say I'm getting a great deal? I don't think that's the truth. I think that 80,000 dollar per door, building, you have to look at everything that's going into it. Are you buying it at a going in cap rate of X, and are you being able to cash flow? Are you going to be able to, add value to the building for in our case? And then, can I sell it for maybe $100,000 a door? Can I refinance out my money? And so I think the price per unit, I think a lot of people look at, and I'm not saying it's a bad measure, but I'm also saying that it's too quick of a measure to
Sure.
actually use to say, oh my God, I'm buying it, dude. Somebody calls you right now and says, John, I got a building in Bronzeville, pick it up for $70,000 a door. Oh my God. But, what are we talking about? What is
Right.
it exactly? And does that, just because we sold a building for $160,000 a door, does that mean that sizes matter? We're on a price per square foot basis, right? We have, the smaller the units, higher the price per foot we're going to get. Are those units 1,000 square feet? Are those units 800 square feet? Everything depends on rent. So, my 1,300 square foot unit is going to get a less price per square foot as opposed to my 800 square foot unit, right?
Hmm.
And I can have a 1,300 square foot 2-bedroom, 2-bath, and I can have an 800 square foot 2-bedroom, 2-bath.
Sure.
So,
Absolutely.
so yeah,
Great
so if
point.
I can say, okay, that traded for 160, but it was also 40% larger,
Sure.
so using that price per unit, you got to be very careful. You got to understand exactly what it is. And I personally don't look at everything on a price per unit basis. Maybe a lot of people do. Me personally, I don't. I always ask myself the question, what are we buying in place? Or maybe it's vacant. So you're buying it at a zero cap.
Hmm.
You're buying it at there's no income coming on it. This is how much money I have to put into the deal. This is how much money I need to be able to get out of the deal in an X amount of time frame. And this is how much money is going to bring in after debt service. And this is how much money I can potentially sell for, whether that be in years 3, 5, 10, 15. We have to look at it. So, yeah, I
Yeah.
think
No, all great points.
I think that was very, sorry.
No, that
That,
was awesome. That's exactly what I want.
my veins, I got like veins are popping out of my
Well,
neck
because we do,
because we love this.
we
This is
love
our
this, and
problem.
we're always going back and forth on that, and
Or maybe it's a 10 cup of coffee I had today. Whatever, however you
the
wanna look
10
at it.
cups and the Red Bull, right?
I know.
Exactly. Uh, yeah. So, and now, what are the challenges? Instead of finding the deals, are you seeing on the operating side? Um, I think there's a lot of growing pains in this business. A lot of people get involved not really knowing. I mean, we already talked about the budgeting. We talked a little bit about the some of the taxes, surprises, some of the theft. But like, what are the some of growing pains in the operating side, on the management side?
Um, I would say number 1, I think is, well, I wouldn't I don't know I don't know if I necessarily put it in order, but I would say, you know, managing, especially us where we're managing, our own projects, our own buildings, I think staffing is a big key
Oh
to
yeah.
this. I think making sure that people show up, do what they say they're supposed to do. Making sure that they have the tools that are necessary in order to perform their job. Um, Management is one of those businesses where, it's a you almost have to know. Um, you almost have to know how to use the tools effectively, right? So management, I would also say includes your accounting, your collections. Are we putting, are you putting 5-day notices religiously, even though a tenant's late? And are you treating everybody fairly? So, oh, one guy didn't pay rent, the other guy paid rent. He paid half of rent. Does he get a 5-day notice? Does he not? Oh,
But
he's a
he
good
shared the
guy.
story. Yeah,
Yeah,
he's going through
and
some problems.
everybody's got issues, right? So, how do you actually make sure that you can maintain a successful management, you could say company or management process, with keeping those, back to what we're saying, those principles intact. So, everybody needs to be treated the same. I think, collections is the bread and butter of our business. That's how, we get our valuations. It's based on what we collect. And it's also taking care of people's problems and issues. We're in the rental business. We're in the firefighting business. So it's, everybody's going to have some issues that come up. Sometimes landlords are the hated people in the world because, oh, you guys didn't fix this, you didn't fix that. But guess what? There's some things that we can fix, and there's some things that we cannot fix if you're in the unit. So, can we accommodate you in another unit? Can we move it without losing our without losing crazy amounts of money? I mean, we have to do these type of things. So, um,
Yeah, we've got some. Sometimes I mean, it's kind of crazy because it doesn't matter some of the things that you see out here with the tenants. I mean, you'll be really amazed and surprised. I remember that one tenant that was complaining about fruit flies, and I said, "Well, have you tossed out the rotten fruit spoiling in your kitchen?" Well, no. I mean, you guys are responsible, and I want half a discount on my on my rent. So,
What do you do, right? And then
right.
and then and now you ask, you can pull 10 management companies. You can ask 10 people that are in the management business or that have, experience in managing properties and saying, what do you do, right? You have a good tenant, tenant's paying, they got fruit flies. So what do we have to do? Do we actually accommodate the request, or do we say, I'm sorry, ma'am, sir, ma'am, I mean, we need to you need to take care of this. This is an issue that you've caused, or that there's food that's rotten in here. You need to remove it. Now, every dollar that you put into that goes against your cash flow, goes against your valuation. How much did you spend this year? So, can you accommodate those requests? There's some managers that will. There's some companies that'll say, I'm sorry, that's not our responsibility. They're by the book, and they'll say, so I think finding that medium, and without also, I would say that we like to always take care of issues and our tenants, and I think we go above and beyond what a lot of landlords do, because this is, we're creating environments that this is your home, and we do have a good amount of rental play. Rental base. I would say I think about 85% of our portfolio tenants who have been renewing.
Yeah.
Um, I would say in some years it's actually been more. So, 90%, and we've only had, maybe 10% turnover. But so, yeah, so it's very difficult, I think, in the management business, and that's something to watch out for, something to also keep in line. I don't know. Once you start allowing yourself to stray from those principles, you start to also spend a lot more money and a lot more time. And at the end of the day, it may not be worth it. So you got to examine it, and everybody's got their own way of managing their properties.
And some of the things that I've also seen con- dealing with a problem tenant, someone who's not paid, there's eviction versus cash for keys. Have you preferred any of the? I mean, obviously, it seems like cash for keys is the way to go most of the time. But then you also kind of feel bad letting them walk after not paying a few months.
Listen, we have you should, and this is advice to all the young people getting
Yeah,
into, or the whatever, whoever's getting into the real estate business, and specifically apartments or multifamily rentals. Um, you are going to have to make a business decision. Okay, I can spend $1,000 today, or I'm going to spend $10,000 today, and what's that going to actually set us up for? So, Across the board, we have to make decisions in our business sometimes that are painful. And does it make sense to evict the tenant? Sure. I would say that if you absolutely have taken advantage of the system and you have not paid your rent because of one reason or another, um, and that person also has not reached out to you to actually maybe accommodate a solution, something that you're going to have to make a conscious decision, and you're going to have to say, well, I'm sorry. This is our process, and we have to let you. We're going to have to serve you, and we're going to have to go down this process. And that's it. It's going to cost money. Yeah, you don't. Not a lot of people budget for attorneys' fees. People don't budget for these type of costs and time. And and then you have to turn over that unit. I mean, we've lost tens and thousands of dollars on even one unit alone
Hmm.
because of evictions. And so I would say that keeping those principles intact and saying, you know what, we perform this. If anybody hasn't paid, we will absolutely go after the money or put a judgment on your record. That person may or may not be able to rent another apartment again. And unfortunately, it's a part of our business that we have to deal with. And when we go back to it, the circle back is that also hurts your cash flow
Yeah.
substantially.
Hmm.
So you know, think about it. If you got to pay a couple $1,000s in attorney's fees and filing fees and costs and this and that, plus the amount of money that you've lost, maybe let's say for 3 months, 4 months, let's say at $1,000 a unit per month. I mean, that's 4 grand right there. Then you got to get in and you got to turn it over again. Then you got to probably maybe spend, I don't know, if it's a 1,200 square foot apartment, for 1,000 square foot apartment, you got to spend maybe another buck a foot or maybe even $2 a foot to get everything cleaned out, labor, time, paint, material. And then on top of that, you got to pay commissions maybe. A lot of people are not in the leasing business and they look to others to lease. It's another month commission. And so what? Now you just lost about, give or take, about 10 grand, on your property that you were supposed to cash flow $30,000 a year. 10% of $30,000. You've just, I mean, it's 30 to 40% of what you expected to get just out the door. And that's just one unit. That's one unit. You have 10, you have 5, 8, whatever. I mean, that's so anyways,
No, yeah,
that's that,
that's
that
that.
that's I mean that's really what it is. That's really what it comes down
That's
to. That
yeah.
goes back to, factoring. That means, going back to saying that cash flow model may not be the best way to look at it. It should also look at,
At the equity
all
play
right.
as
So
well.
and if you have, let's say you bought a 3 unit building and all three of those tenants stop paying. Well, guess what?
Well, that leads me into another point, which is economies of scale and the importance of having more units. I know that we've been doing primarily right now, uh, smaller 3 flat, 4 flats, 8 units, 12 units. So what I would say is, at what point in time are you going to transition out to some of the larger apartment complexes, and what's your take on the benefits of going larger?
If you're listening right now and you have an uncle or you have a cousin, friend, family, somebody that owns a 100 unit building in a great or a good area, I would say, uh,
Give us a call or
and has not put money back into their property in over whatever 5, 10 years, and is tired and is not conducive to what the market actually what the rental market in the area looks like. Absolutely, give us a call. We will absolutely find a way to compensate you if it's off market, and we will absolutely find a way to go after this property. But yes, absolutely, the transition is based on how many people give us a call on this. You
on
know,
this
on this
podcast.
podcast, I guess.
Absolutely.
But yeah, no, we wanna do deals. I know the time is gonna come. And listen, a lot of the products also dried up, so we have to either wait for those opportunities or I think another thing we really didn't. I mean, we've kind of brushed on, but readaptive reuse. We would love to find office product out there that's 3 stories. With Class C properties that are either vacant or leased, and they're tired, and we'd love to redevelop them. If they all have to hit the right check marks and boxes, but we would love to find minimum of 40, 50,000 square feet, office buildings, 3 stories, 4-to-1 parking, and with the potential to redevelop them into apartments. But that's a whole nother, I think, a whole nother strategy. And I think we're seeing nice. I mean, we can buy it at an attractive price per foot, and hopefully, you know make them into apartments. I would say there's a lot more office product than multifamily in some of these markets that we're looking at. So, eventually they're going to become vacant, or they're not going to become
Yeah, but there's a lot of challenges there too, isn't there? I mean, with the villages, I mean, an
villages,
uphill
zoning,
ballot. Yeah,
political. Yeah, I mean, but at the end of the day, too, you have to remember what you're buying. And
sure.
if you're buying an office building space, you're basically buying space that you can maximize square footage. What's the best way to maximize it? How are you getting the most dollars out of this building? Is it going to be office, commercial, retail, or apartments? And the market today is, and what based on our experience, is saying that we're seeing a nice return in apartments. So yeah, we're gonna have to take a risk. There's gonna be construction. There's gonna be a lot of things involved, but the returns hopefully should outweigh the risks.
Awesome, awesome. Well, again, Mr. Trivedi.
First podcast ever. I now know what a podcast is. Is this live?
Yeah, it's
Oh, this is
live.
live.
Yeah,
Yeah.
it's
All right,
live.
welcome, welcome.
Yeah,
All
well,
right.
we've got a few viewers on live right
Beautiful,
now, and
beautiful.
it's going to get recorded
Oh
and put out
yes,
there.
very nice. Well, listen, I really appreciate your time. Once again, this is a shout out to the community that any deals that you think that we may be interested in,
Well, how can anyone get a hold of you if they want to reach you?
just type in the most handsome Indian gentleman in Chicago, and you will see a picture and my contact information that pops up. But AUM Capital, we are here. We're here 24 hours a day. And yeah, we're looking for deals. Bring us everything and anything. The worst thing that we can say is no. And sometimes I'll tell you that you're crazy and the price is crazy and you belong in, behind bars.
Right.
But thank you guys very much. And hope everybody has a nice and safe holiday. And
Absolutely.
thank you, John.
Well,
Appreciate it.
thanks, man. Have
Best
a
of luck.
safe trip. Have a safe trip.
Thank you very
Wishing you the
much.
very best. And again, thanks for coming on T minus a few
You got
hours
it.
before your flight.
Don't
So,
sleep in this business.
oh, never. That's a fact. All right. Well, thanks again for everyone joining us on the John Gill Podcast Show. We're super again thrilled that you are all following us. And go ahead and follow the link that we're going to have on the channel that can take you to AUM Capital's contact and all those good details. So thanks again. Have a great night, and we'll be back on the next show.